welcome back. So, let us continue from where we left off, but before we do that, recap of the important issues relating to YTM. The assumptions of YTM, well, the first assumption that is incorporated into the YTM formula, that is there by default, there is no design in it, the formula itself contains that assumption, and that is that the reinvestment rate is equal to the YTM. As I showed that this is implicit in the formula itself. And secondly, because we sum the cash flows up to maturity, there is the assumption that the bond would be held up to maturity, and accordingly all the cash flows arising from the bond up to the maturity of the bond are discounted when we work out the YTM. Now, because of these two assumptions, we in a sense we isolate ourselves from the environment. What I explicitly mean is that because the reinvestment rate is equal to the YTM by default. So, there is no external intervention there, and at the same time because the bond is to be held to maturity or presumed to be held to maturity, the maturity value of the bond is also given upfront, that is, it is incorporated in the terms of issue of the contract, and therefore, there is no external inputs except for of course, the market price at the point in time at which we are calculating the YTM. So, and even that is explicitly known, because obviously, the price at which the security is traded is known at the point at which we are working out the YTM. So, because of these features, a given cash flow pattern will return a unique YTM. The relationship between the price and the YTM is that of 1-to-1 correspondence for a given cash flow pattern. In other words, the YTM is uniquely determined by the price of the instrument or the price at which it is being traded for a given cash flow pattern. Now, this is subject to a caveat. The caveat is that in explaining this particular point, that there is a 1-to-1 correspondence between the YTM and the price of a security, we have implicitly assumed that the cash flow pattern arising from the instrument or the underlying financial instrument is one of a conventional nature. What exactly we mean by a conventional nature? Well, a conventional cash flow pattern relating to a security is one where you pay the price upfront and then you get the returns from the security, you get cash inflows from the security over the remaining period or the remaining life of the instrument. In other words, there is one cash outflow at the initiation or at the point you take up the investment position, you enter the investment, and thereafter the investment rewards you with cash inflows over the life of the instrument. This is the conventional cash flow pattern which we assume when we talk about YTM and so on and other measures of yield. However, if there are multiple sign changes in the cash flow pattern, in other words, if there is a cash outflow to start with and then a sequence of cash inflows and then again a cash outflow, for example, payment of call money or such similar payments to the issuer of the securities as are incorporated in the terms of the contract, and then subsequently some more cash inflows and then again a cash outflow. In other words, the cash flow pattern undergoes multiple sign changes, then the YTM that may be returned for a given price may not be unique. To illustrate my point, let us consider a security, let us consider an investment with the following stream of cash flows. At t equal to 0, that is the point at which you have taken the investment in the security, we have a cash outflow of 1 unit. Then at t equal to 1, we have a cash inflow of 4 units, and then at t equal to 2, we again have a cash outflow of 3 units. The YTM of the stream of cash flows, if you work them out, returns y equal to 0% and y equal to 200%. So, you end up with having two values of YTM for this particular cash flow. Therefore, it is necessary to assume or as an underlying assumption that the cash flow pattern envisaged in the security has only one sign change, that is, it is a cash outflow followed by a sequence of cash inflows. Now, while there is a unique YTM for a given pattern of cash flows and price for a conventional bond, there is no restriction with respect to number 1, two identical cash flows trading at different prices and therefore returning different YTMs. And similarly, there is no restriction of two different cash flow patterns having a same price and thereby again returning different YTMs. We come to a very important aspect. The important aspect is that YTM is essentially a discount rate, and as is normally the practice or one of the methods for accounting for the risk in the realizability of cash flows emanating from an investment, the discount rate encodes embraces the riskiness of the realizability of the cash flows. So, in that sense YTM is also a risk adjusted discount rate. It is the discount rate which incorporates within itself, encapsulates within itself the risk profile of the investment as perceived by the market, because we are working out the YTM on the basis of the market price of the security. So, the riskiness or the perception of riskiness that is encoded in the YTM is that of the market as or the collective wisdom of the market. Therefore, two bonds which are having identical cash flows may very well trade at different prices and have returned different YTMs if they have differing risk profiles, or if the market perceives the realizability of the cash flows to be different. The bond that has a higher riskiness with respect to the realizability of its cash flows would obviously trade at a lower price and realize a higher YTM. This justifies the contention that the YTM is a risk adjusted discount rate. Higher the riskiness, higher is the risk premium added to the risk free rate when we work out the YTM of a particular security. Conversely, if two bonds carry similar risk perceptions in the market, they would be trading at the same YTMs irrespective of the pattern of cash flows encoded therein. So, what does that mean? How would that happen? Well, that would happen by the price realigning itself in line with the cash flow patterns. Let me give an example to you. Suppose there is a bond that is quoting at say, let us say INR 900, and that bond has a coupon rate of 10% and redemption at the face value of 1000. Now, let us consider another bond which has a coupon rate of say double of that coupon rate and the redemption value is also double. Then and the bonds have similar risk profiles as to the realizability of cash flows. Then the two bonds would be quoting at the same YTM, notwithstanding the fact that the cash flows from the second bond would be double that of the cash flows from the first bond. How would that happen? That would happen by the price changing itself to align itself with the cash flow pattern of the second bond compared to the first bond. They would obviously not quote at the same price. The price would align itself in such a way that the YTM on the two bonds remains the same, provided the riskiness on the two bonds remains the same. Now, we quickly recap the theorems that we did in the last lecture and then move on to some fresh results on the YTM. For a fixed rate bond that does not default and has a reinvestment rate equal to the YTM, an investor who holds the bond until maturity will earn the rate of return equal to YTM at purchase, regardless of whether the bond is purchased at a discount or a premium. The proof of this is given in this slide. It is quite simple. It involves a little bit of algebra, and we find that the effective annual yield on the instrument is equal to the YTM if the reinvestment rate is equal to the YTM, and obviously this holds for a level coupon bond redeemable at par, as I mentioned in the last lecture also. And that being the case, we do infer that if the reinvestment rate is equal to the YTM, then the bond would return equal to the YTM irrespective of the price of purchase. Now, please note the entire calculation is independent of whether the bond is quoted at a discount or a premium or at par, which establishes the theorem. The second theorem, an investor who sells a bond priced prior to maturity will earn a rate of return equal to its YTM as long as the YTM has not changed since purchase. I illustrated this with this example. Consider a 10% annual bond with a maturity of 5 years trading at a YTM of 12%. The bond is held by an investor for 2 years and sold thereafter at a YTM of 12%. That means there is no change in the YTM, no change in the market interest rates during this period of holding of 2 years. We calculate the return to the investor on the basis of his holding period of 2 years, and after this calculations which I explained in the last lecture, we find that the return earned by the investor is also 12%, again establishing the theorem at least by way of illustration. This is the explicit proof of the theorem. Again it involves a little bit of algebra, and it involves explicit terms for the PVIFA factor which are at the rate of YTM, which are given here. Other than that, there is one issue worth explaining, and that is the term that lies within the curly brackets in the second last equation, this particular term. And this particular term, if you look carefully, when you simplify this term ends up as CF into PVIFA y comma capital T plus F into PVIF y comma capital T, which is nothing but the price of the bond y, because y is the YTM of the bond. Therefore, by the definition of YTM, the expression within the curly brackets gives us P 0, and hence we have P 0 into 1 plus y to the power h, where h is the holding period, and on comparing it with the expression that we started with, we find that the effective annual yield R y is equal to the YTM y. Then we came to theorem number 3. The theorem number 3 is stated that the value of a bond would decrease bracket increase as it approaches maturity if it is a premium bracket discount bond. As I emphasized in the last lecture, the value of the bond on the date of its maturity must necessarily converge to its par value if it is redeemable at par. Whatever its redemption value is, in fact, it must converge to that redemption value on the date of maturity of the bond to ensure no arbitrage occurring, which is usually the underlying principle for market pricing of a bond, financial pricing of a bond. And therefore, if a bond is quoted at a premium, let us say at an earlier date, it must return to a par value if redeemable at par on the date of maturity, and if the amortization is to be continuous, then at any earlier point in time between say t equal to 0 and t equal to capital T, the bond will gradually be amortizing the amount of premium, and therefore, the value of the bond would gradually decrease. The premium will decrease and the value of the bond or the market price of the bond will gradually decrease as the bond approaches maturity, and on the date of maturity the bond would be trading very close to its par value if it is redeemable at par. The converse is the case if the bond is quoting at a discount. Then we have the value of a bond that is sold at a discount or premium to par will move to the par value of the bond by the maturity date. I have already explained this as part of the previous statement. Then we come to a new theorem, theorem number 4. If the market YTM for a bond, our assumed reinvestment rate increases bracket decreases after the bond is purchased, but before the first coupon date, a buy and hold investor realized return would be higher bracket lower than the YTM of the bond when purchased. For let me illustrate this statement with an example. Let us say today we are at t equal to 0 and we buy a bond, say it is a 10% coupon bond. We buy a bond which is and the current YTM for bond of a similar risk profile is 12%. We buy the bond at say 928, which is the approximate, it is a 5-year bond, 10% coupon bond. So, and if you work out the price of the bond on the basis of a 12% YTM, it comes to 928. So, let us assume that you buy it at 928. let us say very soon, let us say at say t equal to 0.25 or t equal to 0.5 before the first coupon payment, which is to occur at t equal to 1 year, and then 2 year, 3 year, 4 year and 5 years when the redemption will also take place. So, let us say at t equal to 0.25 or t equal to 0.10, the YTM increases. Now, if the YTM increases, what will happen? And it is also given in the theorem that the investor is a buy and hold investor. In other words, he will continue to cling on to the bond irrespective of the increase in interest rates over the life of the bond. Now, because the increase has taken place before the first coupon payment, he can now reinvest the coupon. Now, this is very important. He can now reinvest the coupon that he receives at t equal to 1, at t equal to 2, t equal to 3, t equal to 4 at the new rates, which are given to be higher than the previous rate. Let us say the YTM increases at t equal to 0.25 from 12% to 15%. Now, please note this important feature that we are talking about an investor who is not going to sell the bond in the market, who is a buy and hold investor. In other words, he will continue to hold on to the investment up to the date of maturity of the instrument. So, at t equal to 0.25, there is a change in interest rate or market interest rate from 12% to 15%, and as a result of it, the coupons that he receives at t equal to 1, 2, 3, 4 can be reinvested now, not at 12% which was the earlier market rate, but at 15% which is the new market rate. So, clearly the reinvestment income that he gets, the income that he gets on the reinvestment of coupons up to the date of maturity of the bond would be higher than at the earlier YTM. However, the redemption proceeds would not change, because he is going to hold the bond to maturity. Therefore, whatever was the redemption value as per the earlier YTM would continue to hold, and as a result of it, the total cash flows that he is going to get on the date of maturity of the bond would be higher than the amount that he would get as per the original YTM, and therefore, the realized yield when you work it out over the entire life of the investment, that is from t equal to 0 to t equal to 5 for the investor, would be higher than what it was when the YTM was 12%. Now, we come to the next theorem. The next theorem says that if the market YTM for the bond, our assumed reinvestment rate increases after the bond is purchased, but before the first coupon date, similar to the example that I illustrated just now, a bond investor will earn a rate of return that is lower than the YTM at bond purchase if the bond is held for a short period. Now, let us look at what happens here, very interesting. Let us continue with that example. For that matter, we are again considering a bond with a maturity of 5 years, a coupon rate of 10% with the current market rate, a market interest rate at t equal to 0 being 12%. So, let us assume the current price that we work out is 928 for a 1000 rupee face value bond. Now, let us assume that at t equal to 0.10, that is before the first coupon, which is to occur at t equal to 1, the market interest rates have changed from 12% to 15%. There is an increase in the YTM, increase in the market interest rates. Now, the assumption is that the investor is going to hold the bond for a short period of time. Let us say he holds the bond up to say t equal to 0.50. Let us say he disposes of the bonds, he exits the investment at t equal to 0.50, that is before the first coupon. Now, what would happen when the interest rates change from 12% to 15% at t equal to 0.25? Obviously, the market prices of these bonds would realign themselves to make the YTM of the bond equal to 15%, when that YTM is calculated from t equal to 0.25 over the remaining life of the bond. Let me repeat. Let us assume that at t equal to 0.25, the interest rates make an upward shift from say 12%, which they were at t equal to 0 to 15% at t equal to 0.25. Now, immediately the market equilibrium would be disturbed, and the prices of the bonds would start realigning themselves very rapidly to ensure that the new price of the bond, which would prevail at t equal to 0.25, would ensure an investor who enters the investment at this point in time at this new YTM rate gets that YTM rate on his investment, provided he holds the bond from 0.25 to the date of maturity, which is t equal to 5. So, the prices will realign themselves. Now, what would be the implication of this realignment? Firstly, because the interest rates are increasing, the YTM is increasing, the bond has to give a higher return, and therefore, and the redemption value is fixed, the coupon rates are fixed. So, the only thing that can change here is the price of the bond, and the price of the bond would decrease below the original price, much below the original price. So, that if a new investor enters the investment at this new price, then he would get a return of YTM of 15% over the remaining life of the bond, over the remaining life of the bond, that is from t equal to 0.25 after the interest rate shift to the date of maturity of the bond. Now, what happens to the investor who has bought the bond at t equal to 0 when the interest rates were 12% and who disposes of the bond at t equal to 0.50 after the bond prices have realigned themselves? Obviously, as I mentioned, the prices have gone down. Therefore, naturally the return that would be earned by the investor would be lower than the YTM at which he entered the investment. In other words, the return earned by the investor who had made the investment at t equal to 0 and who exits the investment at t equal to 0.50 would not be 12%, it would be lower than 12%. This decline in the YTM would compensate for the increase in YTM over for the investor who would enter the investment at t equal to 0.25. So, that is how the dynamics would operate. If an investor holds a bond for a short period of time, then the decline in prices would operate to his massive disadvantage if there is an upward shift in YTM, and the return that he would realize on his holding period, which is short holding period, would be lower than the YTM at which he entered the investment. Next theorem, if the market YTM of the bond, our assumed reinvestment rate decreases after the bond is purchased, but before the first coupon date, a bond investor will earn a rate of return that is lower than the YTM if he holds the bond for a long period. Now, suppose we have the same dynamics. Let us say the interest rates now, instead of increasing, interest rates decrease from 12% to 9%, but the investor holds the bond up to maturity. It's important to note that here the holding period is a long period. This is very important. In the previous theorem, the holding period was a short period. Now, we come to a holding period which is a long period. Now, because the holding period is long, let us assume that the bond is being held up to maturity or very close to maturity for that matter. Now, because there is a decrease in the YTM, now what would happen? What would happen is that the prices of the bond would go up to realign with the new YTM. The new YTM has decreased, the original YTM was 12%, the new YTM at t equal to 0.25 has changed from 12% to 9%, and therefore, at this point of time there would be a disequilibrium in the market and the market prices would realign themselves. The prices of our bond, the bond in which the investor is invested in, would increase to compensate for the decrease in interest rates, so that the return, the YTM that is earned by an investor who enters this investment at t equal to 0.25 and holds the investment up to maturity, now give him a return of 9% instead of 12%. The prices will increase. However, now there are two things that would happen. Number one, the reinvestment of coupons that he receives. Please note here, the investor is holding the bond for a long period of time. So, we assume that he will be holding or he will be receiving a significant proportion of the coupons that are payable on this investment. Now, that being the case, when he reinvests these coupons, what happens? reinvested interest that he gets is at 9%, not at 12%, because the reinvestment occur at points in time which are after the change in the interest rate from 12% to 9%. So, the reinvestment will take place at 9%, and as a result of which the interest on the reinvested coupons that he will receive will be at 9% and not at 12%. That is, and therefore, it will reduce his reinvested income, number 1. Number 2, as far as the benefit of the price escalation is concerned, as far as the benefit of the price increase is concerned, that benefit also will accrue marginally to him. Why? Because he is going to hold the bond up to very close to its maturity, and because if he is going to hold the bond very close to its maturity, the number of coupons that need to be discounted at the higher discount rate of 9% would be very few. There will be very few coupons left in the life of the bond which would be necessary for discounting when he works out the market price at which he would be exiting the investment. So, the net result is that on the one hand the reinvested income declines, and number 2, the capital gains that he may expect will also fall, because we are now very close to the redemption of the bond, and please note the redemption of the bond must necessarily be at par value as per our assumption of a level coupon bond redeemable at par. So, if that is the case, the overall return, the overall realization of return that he gets on the investment is lesser than the YTM at which he entered the investment. So, we are now clear about the theorems that relate to the YTM. Now, YTM and coupon rate, I have already explained this particular point, but it is worth recapitulating. So, let us read this out. It may be noted that the YTMs will not depend on the coupon rates. The YTMs depend on the riskiness of the coupons rather than the rates of the coupons. If two bonds are of identical risk, they will return the same YTM even though they have different coupon rates. The difference in the coupon rates, how will the difference in the coupon rates manifest itself? The difference in the coupon rates will manifest itself by realigning the prices of the bond. The prices of the bonds will realign such that if the cash flows of bond B are higher than the cash flows of bond A and they have the same riskiness, then the price of bond B would be higher than the price of bond A, so that the YTM that they return is the same. So, that is an important part. YTM is a discount rate and it is a risk adjusted discount rate. It is a risk adjusted discount rate which is worked out on the market's perception of the riskiness of the underlying cash flows emanating from the bond. Now, we come to certain relationships which I repeat, which hold for level coupon bonds redeemable at par. For a bond which is quoting at par, the coupon rate is equal to the current yield is equal to the YTM. For a bond which is selling at a discount, the coupon rate is less than the current yield is less than the YTM, and for a bond which is selling at a premium, the coupon rate is greater than the current yield is greater than the YTM. The proof is here on the slide. Again, it is quite straightforward. The only thing that needs explanation is the first step. Suppose we consider a premium bond. Now, because we are considering a premium bond, the price of the bond is greater than its face value. Please note, we are again talking about a level coupon bond redeemable at par. So, because we have a premium bond, the price of the bond is greater than the face value, and number 2, the coupon rate is greater than the YTM. That is, we have already established this fact, so we will not go back to it again. Now, the coupon rate is smaller than the is greater than we are having a premium bond. So, coupon rate is greater than the YTM. The rest of the derivation is again quite straightforward. We take the ratio of the current yield and the YTM, and when we work out the ratio of the current yield and the YTM, substitute therein the expression for the current market price of the bond in terms of the YTM, and simplify the expression by using the PVIFA expression in terms of the geometric progression at y for the maturity t. We end up with the expression which is, I put it in a box. And if you look at this expression is greater than 1, because C is greater than y. So, when you are deducting C and adding y, that means what? You are deducting a certain quantity from the denominator, you are deducting a positive quantity from the denominator compared to the numerator. So, the denominator has to be smaller than the numerator, and therefore, the ratio is greater than y, that is the current yield is greater than YTM, and it is quite obvious from the first line that the coupon rate is greater than the current yield. So, at least for the premium bond we have established this result. Absolutely analogous calculations hold for the discount bond, and of course, for a par bond it is quite even more easy to establish that for a par bond all these three measures will return the same value. The coupon rate and the current yield and the YTM all converge in the case of a par bond, in the case of a bond which is quoting in the market at par. So, now we come to the carrying value of a bond. This is again a very important topic, although it is more related to the to accounts, but we need to be acquainted with this topic in the context of the accounting for bonds, accounting for fixed income securities. So, carrying value of a bond at dates between the purchase and the sale of a bond, the value of a bond at the same YTM at which it was purchased is the carrying value. Let me repeat, at dates between the purchase of the bond and the sale of the bond, when you enter the investment and when you exit the investment, the value of the bond at the same YTM at which it was purchased constitutes the carrying value of the bond. This is the value at which the bond is recommended to be maintained in the books as per the international financial reporting standards. This carrying value reflects the amortization of the discount or premium since the bond was purchased. Now, we take up an example of carrying value at t equal to 0. Let us say an investor invests in the issue of 10% bonds of ABC Limited of the face value of rupees 1000 each, INR 1000 each, with a maturity of 5 years. Let us assume that the current market interest rates are 12%. What we are supposed to do? We are first of all, we are supposed to calculate the price at which the issue is to be made, and number 2, we are supposed to calculate the carrying value at the end of each year to be recorded in the books of accounts of the investor. So, let us now look at the solution of this example. Now, the face value is 1000, the coupon rate is 10%. Therefore, the coupon amount is 100, is quite obvious. The life of the instrument is 5 years. The current price is obtained as the discounted cash flow price. We discount all future coupons at the current interest rates. Please note, this is not the coupon rate. We are not to discount the cash flows at the coupon rate. We are to discount the cash flows at the required rate of return as perceived by the market, which is the market interest rate corresponding to the risk class to which the investment belongs. So, we work out the price on the basis of the market interest rate, which works out to 928 as I mentioned earlier. So, what is the amount of discount at which the bond is issued? It is 1000 minus 928, that is 72. So, the first step is already done. The first step gives us that the price at which the issue should be made, the price at which the issue would be marketable is 928. It would not be marketable at 1000 because people demand a return of 12% on this bond and are not happy with the coupon rate of 10% that is contracted on this bond, and as a result of which people would not be willing, the investors would not be willing to get with a return of 10% on this bond, or by taking up the bond at 1000, they would not take the bond at 1000, they would take the bond only at a discounted price because they want a higher return on a bond, which is the currently prevailing market rate for similar risky investments. So, that being the case, the discounting of the cash flow needs to be done at 12% and we return a price of 928. We shall continue from here after the break. Thank you.